Hi everyone, my name is Zoran Kresovic and I'm the head of sales here at 8cap. Welcome to another Trading Battle Week. To some extent, this will be a very special one and slightly different to the ones that have been done previously, having two traders go against each other. This is a very special one actually for me. The reason for that is because we've got an expert on today who is actually going to talk about probably most spoken topic out there in the global markets, but in general, everyday households. We will be talking about inflation. So how about we welcome our guest? He's coming from Hong Kong. His name is Oliver Rust, and he's actually working for a company called Truflation. So Oliver, welcome.
Hey, welcome, and thanks a lot for having me on the show, Zoran. Great to be here with you.
It's an absolute pleasure to actually have you on board. So how about we actually start with a small introduction, and if you want to give us a bit of an overview who you are, what you do for a living, and then perhaps we can actually dig into it, because I'm sure quite a few obviously viewers would be interested to basically hear your thoughts and expertise on it.
Yeah, very briefly. Well, first of all, thanks a lot. Very briefly, I'm from. I've worked my whole life in the data and research fields. Whether it's starting off working in a grocery retailer, progressing my way to running research programs, to running large volume data or census level data, as we like to call it. And now, most recently, worked on setting up and launching Truflation, which is a financial measurement tool, in particular for inflationary measures, but we also do non-inflationary measures as well.
Fantastic, excellent. So just a second ago, it's actually been removed from the actual little window. But if you are interested, please obviously visit the website as well. There is a whole heap of information, valuable information as well. A lot of great tools as well. I've been actually implementing in my analysis, and when I actually go and do live TV and media commentary as well. So it's absolutely phenomenal. So please, if you get a chance, please go and visit the website and basically educate yourself with some great content. How about we actually get started? What I want to talk about is actually a number of things today. So hopefully we will have an hour, and that 60 minutes is actually going to be enough. But nevertheless, the first question is inflation forecasts. Obviously, a lot going on around the globe. You know, at the moment, inflation is kicking in, and basically there is, the banks, the global banks around the globe are actually lifting rates at the moment, or some of them are coming to the end of the rate cycles. What are your thoughts?
Yeah, so I think let's start off with the U.S. market. So I think the U.S. market certainly is seeing a downward trajectory of the interest of the rates, inflation rates. They've been declining consistently throughout this year, probably not at the accelerated pace that the Federal Reserve would want it at, to be frank. But their tightening monetary policies are working. We are in the month of May. The results that the Bureau of Labor and Statistics will be releasing today, we're certainly expecting that to come down at Truflation. Our forecast is that it's going to hit 4.2%. And that downward trajectory is continuing, and that's an outcome of twofold. One is the prices versus a year ago are coming down because last year prices were really high. So the rate of increase is certainly slowing down. And I think second of all is a result of some decreases in the supply-driven cost factors, in particular for more goods rather than for services.
Okay, fantastic, excellent. Okay, and so in terms of the CPI data, obviously that's coming out tonight, I believe, and obviously there's an interest rate, Fed interest rate decision that's coming out, I believe, Thursday here in Australia, but Wednesday night in the US. What do we expect from the market? Like, what do you see? What is the playbook that you believe will actually unfold over the next week or so? At least if you can give some guidance to our traders as well, because a lot of our traders here, when we talk to them at the desk, they're all, all about data-driven decisions and stuff. And a lot of them are actually a lot more macro fundamental than I would say probably the technical side of trading as well.
Yeah, so obviously this is no financial advice whatsoever.
Absolutely. I did actually, my apologies for interrupting. I did forget to say that actually. So everything we discussed today is general in nature. It's not a personal advice by any means. It doesn't take into account, personal nor financial situation of any individual. So yeah.
So based on that, our prediction and our estimation is that, first of all, tonight, in 8 hours or so, the Bureau of Labor Statistics will announce the inflation number. We're expecting that to drop from 4.9 to 4.2%. The market ranging, and the estimates in the market are ranging anything from 3.9 to 4.8. So it's a pretty wide range. But I think the average and the medians are sort of around 4.1 to 4.2. So we're pretty much spot on that. I think the second thing then, as a result of that drop of inflation, the FOMC meeting is scheduled to happen on Wednesday and Thursday in the US, and they'll be making a public announcement. I believe it's at 2:30 Eastern time or 2 p.m. Eastern time on Thursday, the 15th of June. And our expectation and prediction and expectation is that they will hold interest rates and not increase it as previously expected by the market. Earlier, like 2 weeks ago, the market was expecting a 25 basis point increase. Increasingly, more and more people are assuming it's holding flat, and that is very much our prediction, that it's going to be holding flat. So there's going to be no further increases, at least this week, and I suspect that trend will also continue on the next meeting, and then they will see what happens then they'll have the August break, and then they'll see what happens with inflation all the way through till the beginning of September, when they have their next meeting.
Fantastic. Excellent. Okay. So you believe we are actually at the end of the rate cycle, and that 525 might be the tops or the max, at least in the short term. But obviously, more of that will be dependent on the CPI data and, wages, labor market as well, because that's actually kicking off quite, it's quite high in the US at the moment. So in terms of the rest of the year, what I want to ask you is, obviously, short-term pause. And, as we've seen Jerome Powell from Fed actually talking about it over the past 6 months, he's been saying that, May, June, 525 terminal rate should be sort of the max, or 525 to 550. And then obviously market was actually starting to factor in some, interest rate cuts later in the year. What are your views and what are your thoughts on that? Because, quite heavily here, clients absolutely love trading, gold and US dollar. And we've seen US dollar strength to somewhat over the last few weeks. I would say that's probably purely on the basis that market was, as you mentioned previously, factoring another 25 basis point interest rate rise. However, it's been pulling back over the last few days. So what do you expect in terms of the interest rate cuts by the end of the year? And what's your view on US dollar at the moment?
So look, I think the interest rates and where that's going to look at the end of the year, I think at the current state, I don't see, if you look at the Fed and their priorities, which is around the labor market, around financial stability, and around pricing, right? If I break those down, the financial stability, everyone knows. I don't need to talk too much about that. It's been in the press enough recently. I believe that the Fed is pretty strong, and they've made their position clear on the financial stabilities. So assuming that continues, which I don't see any reason why their position should change, you then look at the two other remaining pillars, which are the prices, and you look at the labor market. So if you go and look at the labor market, yes, you're right that the labor market in the US is still really tight. Yes, you're still seeing wage inflation increasing by 5.3%. You are seeing unemployment rate marginally raised from 3.4 in April to 3.7 in May. So yeah, the market is still extremely tight, right? I think you've seen some news in the press that's been announced by organizations throughout the US that are looking at reducing their workforce. And that has been made quite evidently clear through the media. I do feel, though, that they are still, despite that, there's still an increasing purchasing power from the consumer. And this is when it comes back now into the pricing scenarios. So if you've got wage inflation increasing at 5.3, let's assume that inflation stays where it is today, which is at 4.9%, what the BLS predicts it at. which I know is a very far reach. It's definitely going to go down. The question is how much, but let's just assume it stays the same. You still have an increasing purchasing power, right? The consumers now, for the first time in a long time, are facing an increasing purchasing power where the wage inflation is greater than inflation. And I think that is a sign where you're looking at retail sales numbers coming out. That has certainly been increasing month on month in terms of percentage rate versus a year ago, still declining. You then have household debt increasing, and they're increasing particularly in two main areas around mortgages and around auto and car loans, so to speak, auto loans. So that feels that there's either people are going heavy on revenge spending and revenge behaviors from being in the situation, an economic environment that's been in the US for the last couple of years. And I think there's another concern here which would counter all this, which is the current economic growth, right? You looked at quarter four, we're at 2.3%. In quarter one, we saw that number drop to 1.3%. Actually, that's the revised one forecast. The initial forecast in April, was 1.1, and they revised it upwards in end of May for the quarter one GDP for growth to 1.3. So it's halved in terms of their growth. So, so basing all that on the tight labor market, I'm assuming that the interest rates will hold at least all the way through to September. And then what we're expecting is that you'll start to see in quarter four marginal reductions in inflation, in the interest rates and in inflation. But then in the back end of the year, we're seeing already prices increasing. And we're not expecting the war on inflation to be over by the end of this year.
Okay, very interesting view. Thank you so much for that. Very, very valuable for traders and investors out there. So I guess next question that I want to ask you is, obviously we've been predominantly speaking about the US because obviously US is the biggest global economy. US dollar strength, obviously, US is the reserve pretty much currency in terms of the global exports and imports and whatnot. But what I want to ask you is, like, Europe is a big talking point at the moment. China is a big talking point at the moment as well. So if you have a look at the Europe, the inflation over there, we've got the ECB, I believe, this week as well. They actually pretty much priced in 25 basis point interest rate rise as well. To somewhat a lot of economists are saying they're actually heading towards the recession. We've had a lot of issues with the geopolitical tensions between the Russia and Ukraine, and obviously commodity pricing, commodity prices going, through the roof. What's your view in terms of the inflation within Europe? And predominantly speaking, the biggest, I guess, economy is, Germany, France, and the UK. What do you see unfolding over there?
So we're starting to see inflation cooling a bit in the UK. It's off a much higher base, but we're starting to see the UK cooling. And yes, I think you are right. The economic pressures in Europe are significant. I think if you look at all the OPEC countries, I think the UK is probably struggling the most. It's got its most challenges, but I also think there's a longer term growth trajectory that's available, that path that's there that they are progressing forward with. I think, though, from an inflation perspective, I think the UK market, which we have Truflation does have an index on as well, and the Truflation expectation on the UK is that downward trajectory on the UK inflation will continue. I think that is consistent with a number of other markets around Europe. The question is it coming? Is the increase in interest rates going to cause a number of economies to go into recession, or what the potential impact? Can they avoid a recession in due course? But give you an example, the Truflation, if you go to our website, you can check it out. But we're reporting the UK inflation now running at 13.4%. It's significantly higher to what the Office of National Statistics reports it at, but it's certainly come down dramatically since the beginning of this year. And I think that trend trajectory of its continued decline, whether it's in core or non-core, is certainly expecting to continue versus this time a year ago.
Fantastic, excellent. Okay, and just thinking about that at the moment, and obviously, Europe seems to be obviously in a, I'd say, bit of a trouble, in comparison the rest of the globe. Or what do you feel are the biggest risks at the moment? In terms of the global macro views, or in terms of the inflation, in terms of the financial markets, Oliver, like what would you say like would be the biggest risk right now, and what could trigger, like, let's say, a recession around the globe?
Yeah, I mean, there's so many factors in here that it's been hard to say, right? I was worried last month when OPEC announced they're gonna curtail supply of oil prices. I was worried with the increased opening of the Chinese economy that would shoot up the price of oil because of the increased demand. A number of factors. I'm worried a bit about the U.S. coming into an election year in 2024 and what the consequential impact of that is. What the geopolitical, economic state, the status on the Ukraine war, how that's going to progress, what impact that has on supply of goods and services and energy. Given that one of the biggest nuclear power plants in Europe is still in Ukraine, it's still functional. There are lots of different rationales here and circumstances that will change the outlook dramatically. That could easily change the outlook. So it's sort of hard for me to isolate it to one or two areas, but those are some of the big items that certainly on the radar. If you look at the bond market and you look at what their out view is, it's a very different view. It's sort of like, it's a very different outlook, different view to what we're seeing and what some of the external circumstances are. But certainly, I think we have moved away, what I'd say the impact on inflation, I would say we have moved away from a supply-driven inflationary market to now a more demand-driven inflationary market, and the labor market in particular, and how that labor market reacts is going to be a critical factor for the long-term evolution of economic growth.
Oh, fantastic. Nicely summed up. Thank you so much for that. And just moving on to the next question, I would say is, obviously taking into account the inflation, macroeconomics, what you guys do as well over there, Truflation and stuff, methodology for retail traders, how do you normally guys like assess the market, and what are the key takeaways that you guys use to obviously have the edge within the market when you guys actually trade? Like, would you be able to share something with our viewers or with our audience in general?
Yeah, sure. I can share with how we operate and what we do. So thanks a lot for that, Zoran. I really appreciate it. But yeah, I mean, look, Truflation is a measurement tool for inflation in a number of markets. Our intention is to modernize the inflationary measurement tools that exist by government statistics departments, or in the case of the US, the Bureau of Labor Statistics. In the UK, it's the Office of National Statistics, and so forth. These systems that were built up in the past, we have tried to modernize them. For example, we're tracking millions and millions of prices of goods and services across the market. So, example, in the US, I think we're tracking now more than 15 million prices of goods and services. In the UK, that's about 8 million, I believe. I think also what we've also done is to try and disperse the dependency on one approach or one methodology from one data source. So the BLS in the US is really good at utilizing price checking and a survey-based approach, whereas we deal with multitude of different data sources. And so we're operating with about 30, 35 plus data sources that we're operating with to create these indexes. And that gives us, in particular, one other advantage, which is we're looking to create this stuff on a daily basis. Now, that makes a massive difference. So having the breadth and the depth of data that we exist on gives us a pretty good read of really what's happening in the marketplace. And then we verify our data and we constantly check it with other secondary sources that are out there in the marketplace. So it could be housing sales. It could be new housing supply coming on the market. It could be the prices of commodities and how much they're affecting the prices of, let's say, wheat, how much that's affecting the price of grocery shopping in terms of buying rice, pasta, and that type of stuff. All these things, how much copper affects the price in the auto markets, right? And is that a good leading indicator, and so forth? So that's how we to build up the measurement tool, and that's how we manage it every month and every day of the year. And we use that then to create our own forecast and what we believe the outlook is. The trouble is, and I'll be transparent here, the trouble is when we're trying to use our data, which is so comprehensive and much more modern, to predict what the BLS does on a survey of 80,000 items that they check every month. We're running on a survey that's checking, we're checking 15 million items every month. So, we're sort of downplaying our strength into try and predict what they have. And there is volatility in their numbers, just purely based on the methodological approach. Nothing that's right or wrong. It is just purely based on the methodological approach that the BLS has undertaken. And a lot of other governments undertake the same approach. So it's nothing wrong what they've done, and they have a hard challenge themselves. But the scalability of what we are operating with gives us a far more accurate read of what's going on, to the extent now where we are talking with government institutions around the world to be a data provider and have an input into the decision-making processes that governments need to be making based on information that's out there.
That's fantastic. That's excellent. Okay. And just asking out there for the retail traders as well, because obviously 8Cap is a retail broker. Majority of our flow is actually retail investors or retail traders around the globe. And so in terms of the traders, and if they're looking for the information, and if they're looking to actually get in touch and find the useful information, because obviously, as I mentioned previously, it's a huge topic out there. A lot of data comes out every week and whatnot, and the markets are moving and so on. What would be the best way for them to get in touch if they get in contact with us, or if they actually want to reach out to you guys directly?
Yeah, so feel free to reach out to us via our website as a contact us on truflation.com. You can also reach out to us on Twitter, which is obviously @Truflation, or you can reach out to us on Telegram. We have a really sizable community that's coming to our website every single day, and that number is getting bigger and bigger by the minute. And it is also we'll reach out to you, and I think normally we reach out to people in 24 hours, but we're really dependent on the community, to be clear. Because everyone who's got an input and suggestion of where we want to take this business forward, we're going to try and deliver on that requirements, right? People ask us to launch in new markets. We launched the UK. People ask us to go deeper into the explanations of the price movements. We've done that in the US and the UK, and now we're focusing back on geographical expansion, right? And we got markets such as markets like Germany, we got Italy, we got France, we got Scandinavia. We've got markets out in Asia Pacific like Japan, we got Australia, we've got requests for China as well, and also markets that are having high inflationary markets like Argentina, Turkey, and so forth. So we're trying to get a balance of where to go and what the demand is for our clients. So if anyone has got any feedback, thoughts, ideas, or comments to help us, or just want to inquire about the product and have any questions, reach out to us through those 3 channels. Alternatively, there's a whole bunch of information on our resource center on the website, which we highlight all our blogs. There's some predictions in there from previous rounds. We've also got communication updates of where we're operating with, and of course our methodology and a detailed explanation to how our methodology works is on the website as well.
Fantastic. Excellent. Okay, well, look, I'm very obviously self-conscious in terms of time and whatnot. Our time is precious and stuff, but you did mention something just previously that actually caught my ear. And what I want to ask you is, I guess the important topic here is actually specifically trying to bring and paint the picture for our traders as well, is the intermarket analysis. So obviously, the US dollar versus, let's say, currencies or commodities or, major currencies, equities and whatnot. Do you guys have any methodology or anything in particular that you guys use, or basically, compare that or use as a strategy towards your trading, or something that you could share basically for our audience?
So the short answer is no. If someone wants to have that detail, we do, but we use it for our internal purposes. And if someone wants to find out that information, please do reach out to us via the 3 channels that I mentioned earlier, and ask for myself, ask for Oliver, and I'll arrange a call and we can take you through it. It's pretty complex how we set it up. It's by far not the only solution out there, but yeah, happy to have a separate discussion with that. And the reason why I'm hesitant about that is because our approach is not, it's just a different approach, and I don't want to. I'd rather have a one-on-one discussion with individuals about that and how we do the intermarket comparisons and the updates and management around that.
Okay, I've just got a question from a client. So, do you have any projections, or do you have any views in terms of gold? Because a lot of our traders like trading gold, and also the US dollar in general.
Yeah. So, look, the gold. For me, the gold price and the gold market and the US dollar is going to be a lot dependent. Well, not only in the US dollar, not the gold, but the US dollar in particular will be impacted of what's going to happen in the US economy. And the big question here is the US economy going to hit a recession? Right? I think initial estimates were that we're going to skirt away from it and avoid it. Now that given the fact that if interest rates stay at the 5% mark where it currently is, and it doesn't come down, the cost of capital is only going to increase, and that's going to cause constraints, and would likely suggest that potentially that the U.S. economy might see a quarter where we go into negative growth before pulling out. And I think there's going to be, coupled on top of all of this, I think you can have 2 other factors that you're going to be mindful about. One is we're going into 2024 in the US, which of course is the election year. And that's going to have a multitude of other pressures and communications and media positionings that's going to go out there from both the Republican parties and the Democratic parties. And I think then the other factor to be mindful about is what is the longer term view for the interest rates. And if you look at interest rates in particular in the US, I don't know at the current rate and the current trajectory, I don't know why the Fed would reduce interest rates in the short term. Right? There's no rationale as to why they would reduce it. They're very adamant on their positioning to get prices under 2%. Until that happens, I don't know what incentive there is for them to bring it under control. Right? And there are a number of reasons for this. If you look at the housing market in the US in particular, the housing market has been rising month on month for the last couple of months. I think it's since about February this year. It's been on the rise. The number of properties sold in the month has been increasing month on month. Plus, on top of that, you have a 30-year fixed mortgage rates that's now hovering just under 7%. So it's the high 6s, low 7%. And I think that is a real impact on the impact that has on someone's mortgages. It's double, right? And so my viewpoint, therefore, if you take all that into account, if someone has to pay double the amount to get a new mortgage today for the same property, and if the U.S. government and the Fed is very particular trying to get this under control, then the tight monetary policies is going to continue until that inflation number comes under 2%. The consequential impact, of course, is whether the U.S. goes into a recession, and that will have an impact on the U.S. dollar. But I think the U.S. dollar will go from strength to strength again. I'll have a few ups and downs in the back end of the year and going from where we are now, but I think it will remain strong. And if it continues to remain strong, I am more optimistic about the U.S. economy than I am about the European economy and the outlook that they have. But I think the U.S. dollar will hold strength, will be strong for the remaining part of this year. And I think then the consequential impact will be more about if the gold market goes up, who's driving that? It's certainly, I think it's less likely to be, more driven from alternative markets rather than the U.S.
Yeah, I couldn't agree more. I think it's more, if you have a look at the emerging markets, or the new kids on the block, as they like to call the BRICS, I think a lot of the demand for gold is actually driven by these countries, to be honest. And we have seen massive reserves in gold by getting built up by Russia, China, Saudi Arabia, and whatnot. So definitely.
Yeah, and if you also look at Asia Pacific, look at Zoran from Asia Pacific's perspective, everyone loves gold in Asia Pacific.
Absolutely.
It's the one default everyone goes back to if there's an economic stuttering going on around the world. And so I think that dependency is less in the US. But I just think I think the US dollar is going to continue to be strong, and I've got more faith in the US market than I do in the European market for the foreseeable future.
Yeah, fantastic, excellent. Last question. Equities. What do you see in terms of equities, or do you actually monitor or watch the market? Because it's actually very interesting. If you have a look at it, like S&P 500 at the moment, so you got like 7 or 10 stocks, I believe 10 stocks actually, top 10 stocks, especially the tech sector as well, is actually driving the majority of the market. If you have a look at the, equal weighted index and stuff as well, like you can see that like pretty much all the returns are coming from those big players like, Apple and Microsoft and Meta and the rest of them. And then if you have a look at the rest of the stocks as well, on there, like around 490 stocks on S&P 500, they gained only 0.1 percent year to date and stuff. So there is a massive divergence in terms of the top end of town, versus the rest of, especially for those huge market cap stocks who are actually absolutely driving, and Nasdaq is hitting all-time high as well. Do you have any views on that, or would you like to share anything with us?
Again, I don't want to give any advice on financial advice that what we're
Absolutely.
doing, what we're doing on our data. But
yeah.
Having said all that, I think there are a number of things that we're looking at, and that we're keeping a very close eye on. First of all, I think all the tech stocks had a huge growth this time last year, right? With all the e-commerce growth, I think that will continue. But I think people are so into revenge behaviors. That's meaning that people are getting out more, people are flying more. The cost of aviation is still ridiculously high. I think people are going back on holidays. People are going back on business trips. People are going for face-to-face meetings. So looking at things like, the impacts and consequential impacts of that, especially as oil commodity prices continues to go down. I think it's hovering around just under $70 a barrel now. That's what we're looking into. So whether that's airlines, hotels, transportation costs, they're certainly seeing a bit more growth potentially onto their trajectories. There are alternative other areas where we see less optimism in terms of growth, and in the food market, in the food category, I think there are prices that are supply-driven forces that's caused an increase in prices have slowly been replaced with demand-based pricing. And as the economic stutters and stumbles a bit, then I think people will be a lot more conservative, and the retail environment will start to be a lot more competitive as they vie for the hearts and minds and the wallets of those consumers and their hard-earned cash. So I think it's pretty interesting where our viewpoints are, and looking at the data that we're publishing and what we're looking into should give you a pretty good indication, at least where we're focused on.
Fantastic, excellent. Well, Oliver, we have actually gone a little bit over time, but nevertheless, it's very interesting, and I absolutely love this conversation. So, from the bottom of my heart and from the rest of the crew here, we want to actually thank you for your time today. I know you're quite busy and a lot going on. If you do want to get in touch with Oliver, please, obviously, check out the website, Truflation.com. Also, if you want to get in touch with us, or you've got some questions that you actually want us to relate back to Oliver or get in touch with him, perhaps for the next session that we do, and hopefully we will do it in the future, by all means, please hit me up on Twitter or LinkedIn, or basically contact us directly here at 8Cap. All the information is just below. But Oliver, thank you so much for your time. Hopefully, I believe our clients and our audience will actually find this very valuable. We will keep in touch, and hopefully we get to speak soon again and continue this conversation, because there is a main topic out on the street, definitely.
No, Zoran, thank you very much for having me on. It's been a real pleasure, and love to talk about inflation. Obviously, I'm biased about it, but it's not normally the most sexiest of topics to be talking about. But I love it, and certainly love the discussion with you and the team. And certainly, thanks a lot for having me on board.
Thank you, guys. Thank you, Oliver. Enjoy.